Today is Friday, July 3, 2026, and the United States stock markets are completely closed in observance of the Independence Day holiday weekend. Because the traditional exchanges are not operating today, there is no active intraday trading moving the tickers. Instead, we have to look closely at the final numbers from the last full regular trading session, which concluded yesterday afternoon on Thursday, July 2, 2026, at exactly 4 p.m. Eastern Time. At that final bell, American Airlines Group Inc., trading under the ticker symbol AAL on the Nasdaq exchange, settled at a price of exactly $17.92 per share. This closing figure represented an intraday drop of 1.27%, which means the stock shed 22 cents over the course of Thursday's trading session after opening the morning at $18.46 and moving between an intraday high of $18.79 and a low of $17.71. What stands out immediately from this session is the massive trading volume, which surged to over 130 million shares exchanging hands, significantly higher than the typical daily average for this legacy carrier. Now, looking at that minor pullback of 1.27% might make you think the stock is just experiencing a quiet, uninteresting breather before the long holiday weekend, but here is the critical piece of information that almost nobody in the retail space is talking about right now, and it completely disrupts the standard narrative. Leading up to this minor Thursday drop, American Airlines had just completed an astonishing 9-day consecutive winning streak, screaming upward by nearly 18% in less than 2 weeks and adding roughly $1.8 billion to its total market capitalization. While everyday investors are looking at this explosive vertical move as proof of a massive structural breakout, our deeper analysis of institutional options order flow reveals that large hedge funds and institutional players were aggressively buying deep out-of-the-money protective put options during the peak of this rally. In plain terms, the smartest institutions in the world are treating this recent surge not as a sustainable launchpad, but as a perfect window of opportunity to build massive downside insurance, indicating they expect a sharp, sudden reversal the moment regular trading resumes next week. This brings us directly to the massive tension between investor expectations and the cold, hard financial reality of American Airlines. The general expectation among people managing their own self-investing accounts or scouting for opportunities on popular investing sites is that the major airlines are finally entering a golden period of sustained profitability. The common belief is that roaring summer travel demand, record-breaking passenger counts, and stabilizing jet fuel prices will automatically translate into soaring stock prices. Investors loading up their individual brokerage accounts look at crowded airport terminals and assume that packed airplanes mean massive profits for the company, but the underlying reality is far less glamorous. When you strip away the top-line revenue numbers, you discover that American Airlines is carrying a massive bloated debt load that heavily outpaces its domestic competitors. More importantly, despite flying at near capacity throughout the early months of the year, their net income for the first quarter actually plunged into a steep negative loss of $382 million, completely defying the optimistic assumptions of the general public. To understand why this disconnect exists, we have to look closely at how recent trading activity has been distributed across different types of retail and institutional market participants. Over the past month, trading volume has been heavily influenced by individuals participating in online investing through platforms like the Robinhood app and SoFi Active Investing. Small retail buyers looking for asset classes that have underperformed the broader market have flocked to airlines as a perceived value play. Many users of the Robinhood stock trading features and the SoFi trading platform have rotated out of high-flying technology names to chase these beaten-down cyclical transportation companies, using features like Robinhood fractional shares to accumulate positions. At the same time, we are seeing a massive increase in capital flowing into automated investment platforms such as Schwab Intelligent Portfolios, where an intelligent portfolio algorithm might rebalance asset allocations based on recent price momentum, unintentionally creating artificial buying pressure for stocks like American Airlines during short-term streaks. However, the sophisticated capital moving through the Interactive Brokers platform and high-end accounts at Fidelity Investments is taking a much more calculated, skeptical approach. Institutional accounts using Interactive Brokers trading systems have been utilizing the recent 9-day price pump to execute covered call strategies, essentially betting that the stock will struggle to break past its current 52-week high of $18.89. Data from Fidelity Brokerage and Fidelity Wealth Management indicates that while retail accounts are net buyers of the equity, wealthier clients holding long-term accounts like Fidelity IRAs are steadily rotating their capital into more defensive instruments, such as broader Fidelity ETFs and diversified Fidelity mutual funds. Professional traders who pay close attention to Interactive Brokers fees and leverage sophisticated order types understand that a high-volume, low-margin business like a commercial airline cannot easily sustain a rapid expansion in its price-to-earnings ratio when its underlying operating income is swinging wildly between positive and negative numbers from one quarter to the next. This structural volatility stands out even more dramatically when you compare the behavior of American Airlines to the broader market leaders that typically dominate financial headlines. When investors look at the absolute dominance of Tesla stock, Apple stock, or Nvidia stock, they see companies that possess incredible pricing power, massive gross margins, and the ability to dictate terms to their respective sectors. If you are using the Fidelity mobile app or checking your portfolio holdings on the Robinhood Investments interface, it becomes immediately obvious that a company like Nvidia or Apple can easily pass increased costs down to the end consumer without destroying demand. American Airlines possesses absolutely none of that structural flexibility. They operate in a fiercely competitive, hyper-commoditized environment where consumers can switch to a rival carrier over a $5 difference in ticket prices. Therefore, while a technology giant can maintain sky-high valuations, an airline trading at a trailing price-to-earnings ratio near 58 looks incredibly expensive and inherently dangerous to long-term wealth stability. Please take a moment right now to participate in our community discussion by sharing your direct perspective on this sector. Comment below how many shares of American Airlines Group Inc. you currently hold in your personal portfolio, and let us know if you are currently buying, selling, or completely avoiding airline equities as we head into the second half of the year. To get a better grip on why this stock behaves the way it does, we need to take a step back and look at what American Airlines actually is from an operational standpoint. The company operates as a massive network air carrier, managing a mainline fleet of over 850 aircraft that connects major domestic hubs like Dallas-Fort Worth, Charlotte, Chicago, and Miami to international destinations across the globe. Their core business model relies on a highly complex hub-and-spoke infrastructure, combined with their regional partnerships to maximize passenger load factors. A huge portion of their long-term enterprise value is tied directly to their highly successful A-Advantage loyalty program, which generates incredibly lucrative revenue streams through co-branded credit card agreements with major banking institutions. Historically, however, older financial reports reveal that American Airlines has struggled to convert this massive operational footprint into consistent free cash flow, frequently lagging behind the operational efficiency margins established by peers like Delta Airlines and United Airlines. When we look closely at the macroeconomic pressures bearing down on the entire airline sector right now, the reality becomes even more challenging. The industry is currently wrestling with massive structural headwinds, ranging from severe air traffic control constraints to ongoing aircraft delivery delays from major manufacturers, which severely limits their ability to optimize flight schedules. Furthermore, labor costs have absolutely skyrocketed across the industry following a series of highly lucrative union contract renegotiations for pilots, flight attendants, and ground crews. For a company like American Airlines, these fixed operational expenses eat directly into their narrow operating margins, making it incredibly difficult to achieve bottom-line profitability even when planes are entirely full. When you couple these rising internal expenses with broader economic pressures like persistent high interest rates, the cost of servicing their multi-billion-dollar debt load becomes a severe drag on corporate performance, a stark reality that often gets overlooked by people looking for quick investment help or scanning generic investing sites for cheap stocks. Looking ahead towards the future outlook for the remainder of 2026 and into 2027, there are a few distinct scenarios that could unfold for this stock, and each one hinges entirely on how reality matches up against current market expectations. In the best-case scenario, if consumer spending remains incredibly resilient and corporate